understanding how to be in one structure versus another is somewhat important. Now, do you have to dive into it and do a dissertation with a 10-page attachment on all of this? No. You literally just need to talk to someone that directs you it puts you in the right direction of what structure, how you're reporting it, and last but not least, what are you doing within your bookkeeping and your expense data pool that is maximizing for your business alone.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
Have you ever felt the sting of taxes every year? Oh, I'm telling you what, that's something that goes across the nation every single year. And if you've ever wondered, is there a better way out there? Do I have to be paying this much? Am I missing something? More than likely, the answer is yes. And if you're that person asking that question to yourself, you're already partway there. Just surrounding yourself with the right people, that way you can ask the right questions, is really important. Today's conversation is with an awesome husband and wife team that are taking the sting out of taxes. And today we're going to discuss a few things like how you can write off a certain amount of money that you're paying for your student loan. Even if you're making six-figure income, you can still qualify for these. How you can pass more money to your family through your corporation structures, through your corporate structure. Just a great conversation today with a great couple. Everybody, please welcome from Busy Bee Advisors, Erica and Melissa to the show. Here we are, Melissa and Eric. Welcome to the show. How does it feel to be famous and on the show, The Real Estate Mogul MD?
It feels pretty great. I can hear the crowd cheering in the background. It's amazing. Thank you. Thank you for having us today.
I'm having a tough time hearing you over the crowd. Are you there?
Yes. Thank you for your time. I really appreciate it. It's awesome. I'm ready to dive into this. I love talking about this stuff. I know a lot of people do, although there is some negative, stigma or perspective when it comes to bookkeeping and accounting and taxes, right? There's so much to it. But the joy and the knowledge is something that I can relate to personally. That's what I want to kind of get out there today and talk about, the exciting pieces of it, because the excitement comes from the real world results, right? So how many listeners out there today and how many people have you talked with who have penned six-figure checks for taxes, right? That alone is the pain and misery that comes up. And so much of that too, okay, and there's a reoccurring thing that happens, but I want to talk a little bit about, these trigger events too. So when we know something's going to happen, how many doctors, dentists build practices to sell them and create these trigger moments, and then end up paying so much in taxes? This is why it's exciting to me. That's why I'm excited to get into this conversation. So Melissa and Eric, where do we start? Who are we talking with today? Tell us a little bit about yourselves.
So I started Busy Bee Advisors with thought of it being just a bookkeeping firm when our oldest son was a junior in high school. I was in corporate America and working 80-hour weeks, 90-hour weeks, and felt like I was missing everything. Even though I was in an executive level position, I still felt bad anytime I had to miss time for a water polo game or this event or that event. And honestly, one day I just, it may have been fueled with a pina colada or two, and we may have been in Mexico on vacation, but I had just really had enough. And on the spot, I quit my job. And then in just magnificent fashion, as it seems like things happen in our lives, came home, decided to go for a run and kind of figure out what the next chapter of my life would look like. And I fell. And I say that and people are like, oh yeah, you fell running. And I'm all, no, I mean, I fell and the dental bills, we're pretty sure we at least paid for his boat and if
Oh, wow.
not a second home. So I think close to $90,000 in dental bills.
Oh.
I just, that instinct of like, put your hands out when you're falling. Apparently I don't have it. I landed flat on my face at a full sprint. And what that gave me though, right? Always a positive person, I think. What that gave me was some time where I could kind of build this perfect, ideal business in my mind. And so once my jaw became unwired and I was able to kind of communicate and things like that, I hit the ground running and I knew what I wanted and I knew what my non-negotiables were. And you know, we really were able to gain clients. There was a need for helping people, small business owners, medical practice owners who had maybe lost their biller or their person who had been on staff that had been doing that. And it was great for a while. And then right before COVID, my now business partner, who has been my husband and life partner for close to 20 years, it was New Year's Eve, or just before New Year's Eve, actually. And I really wanted to go out with friends. Sounds so funny, but he was a nurse at the time. And that meant that he was either on shift New Year's Eve or New Year's Day. It was never an option to have plans. And I looked at him and it was just this moment of, it would have been tightening our belts a little bit. But I said, you know, I think you should quit your job. And I think you should come and work with me and it's going to be awesome and rainbows and sunshine. And what could possibly go wrong? And I guess I didn't really think he'd say yes. Like I wanted him to, but I didn't think, and he said yes. And it's been truly amazing. I know that not everyone can work well with their spouse. I happen to be blessed with a spouse that we work very well together. We understand each other's, strengths and maybe are able to kind of pass the ball back and forth to each other. But what he was able to bring, because he had been in previous life experiences in the realm of finance, what he was able to bring was this analytical mind that I didn't necessarily, I had it, I knew that it was out there. I knew that there were people who were offering better services as far as tax went, but it was too risky for me to step away from this bookkeeping firm that was going very well to dive into tax and kind of not know. And so that was what we talked about of how can we be different in the tax realm. And, and I'll hand it over to you, Eric, and kind of let you talk about your experience there and what it meant to you. And maybe, I'll let you go from there.
I've been involved with numbers for businesses ever since I was 18 years old, and my family had a construction company. So being involved in that was not necessarily a big change. The real estate industry took a dive in '08, and I decided that, you know what, I'm going to change to a field that is always going to have a job, always going to be paying really well, and I became a nurse. And at first I did correctional medicine, and then I moved on to being an infection control specialist, for several different facilities. And I came down to it that I didn't necessarily appreciate nor enjoy the bureaucracy that came with the job anymore. I loved working with the patients and I loved working with, my fellow staff. But what I didn't like was the management side of it. So I was already in the back of my mind looking, and at this time I had been in the nursing industry for, close to 8 years. And I just decided, you know what, I think I need to transition somewhere else in the medical field. I got to move. I got all this other skill set. I've been doing taxes for myself and for friends and for other people for a long time. I know a lot of tricks, as people like to call them. And Melissa then said, hey, you know what? You should quit your job. And I'm like, I should do it. And so in December of 2019, I gave my notice, and then 2020 hit. And so our business, so I'm out of the healthcare industry, and I'm now doing this full time, and getting a great education. And back to Melissa, I like to refer to her as having the $90,000 grill. There's a few checks to change. So it's been kind of a roundabout transition, or a roundabout way for me becoming a strategist, a tax strategist, and applying my skills that I've kind of picked up from personally having small businesses, because me and Melissa have owned several small businesses, cash-based businesses, in particular. And I didn't necessarily agree or understand why H&R Block did what they did. I didn't understand why a CPA did what they did. When I was reading some of the same rules and researching it on Google, and I was like, why doesn't this make sense? And so then I started diving deeper. I started taking classes. I started talking to other CPAs and strategists, picking their brain on why don't we do this? Why don't we do that? And I started kind of educating myself in a lot of those areas. And the next thing I know, is that I have other professionals in the field that are coming to me asking me these questions. And so it kind of transitioned over a few years period from me being the novice, the journeyman, over to being someone that others consider to be, an expert in the field. And I appreciate that moniker from others. So I would say, when we come roundabout to where we are in a journey, me and Melissa are not joking around. We really kind of went in a roundabout way to where we are now. And your original question or topic setup, I talk to clients on a regular basis that tell me, yeah, last year I paid $119,000 to the federal government, and to the state of California, I wrote another check for $43,000. Eric, I don't want to write checks like that anymore, because I am a six-figure salary employee for a company, and I make a lot of money, but then I have a lot of investments, and I have real estate properties and stuff like that. How do I take more advantage of the tax codes so that I don't have to have that bill anymore? And then that right there starts the conversation. On average,
can I interrupt for a second? And that person that asks that question is I would say the minority. The person who's asking the question is the one who has enough knowledge to be aware that it could be different. They just don't know what the slight tweak is that they need to do. It's the other, 99% that we will talk to when we, have public speaking events, or when we speak to groups, or just are out and meet people that just have accepted that it is the way that it is, that they have to, kind of write the check for 40% of their income to just go away, and they feel helpless towards it. Sorry, I just wanted to interject that.
And those people that write those checks and have 40% of their wages and their passive income just go out the door to a federal and state agent, and they're like, what am I doing wrong? Because I know lots of other people are not paying a price tag at this level. Are they really? And I say, no, a lot of them are not, because they have it structured different. Sometimes it's not, you may have an idea of something needs to be different, but you don't know what you don't know. So if I have a problem with my foot, even though I have a lot of education in regards to healthcare, I'm still going to go see what I perceive to be a professional to help me out with my foot. The home treatment thing is probably not going to be the route that I go with. I'm going to ask a professional. I'm going to ask someone, hey, I have this idea that it should be different. How do I make that idea now a reality? And on average, when I interact with my customers or my clients, and I get them to change how they're doing their business, change their business structure, change their bookkeeping, and put additional policies and procedures into place for their corporation, they go all of a sudden that they're having these tax bills that are, 70,000 plus a year, that's dropping down to like into the mid 20s. And it's how do you do that? You use the tax code to your advantage, the same way that Alphabet does, the same way that Microsoft does, the same way, Intel, all of these other corporations, they're using these same codes, tax codes, to generate benefits for them. Why can't you do that with your own company? The answer is you can.
I hear a little irony in the story there because you weren't happy with the bureaucracy in the previous profession, and then you come to something like the IRS, and it's the bureaucracy of that is overwhelming to the point it is untouchable or kind of like out of reach for that 99% that you're talking about. They don't even know that they should be making these changes. Eric, you mentioned something interesting. You mentioned three things there, not how they're doing business, but the structure of the business and the bookkeeping that led into these changes. Those two areas, the structure of a business and then the way that they're doing bookkeeping, what are some of the top things that you can see or stand out to those 99% of us who don't know that there's a difference, that I don't have to pay the easy button for Intuit, QuickBooks, or whatever to pay as much taxes as possible to keep the preparer safe?
Well, Melissa, a while ago, put together what I call the scream sheet. And it is over 100 small business deductions that you may not have realized you could take. Because there is so many areas of the tax code that get taken advantage of because the companies hire people that specialize and learn. And that's kind of, you look at it, you go, wait a second, I didn't realize I could write off these 10 additional items at a price tag of an extra $20,000 in expenses that I was paying out of my pocket, that you're telling me now I can write off against my taxes because of my business? The answer is yes. Just because you have a couple of rentals, or you're picking up houses and you're flipping a couple of them every year, stuff like that, doesn't mean that you can't develop a corporate structure. Corporations have a much better tax setup to start with than sole proprietors or people that file Schedule E's for their rental properties. Now, if you got a rental property, you still have to file a Schedule E, and you have to go through all of that. But what if all of the money that came from that rental property first went to your corporation and then got distributed out to you, and you controlled how much money came in from that, because you're the one making decisions not only for your corporation, but also for your rental property.
And so to take it back a step, I think one of the big, people listen to podcasts and they want some takeaway, right? They want some valuable nugget. And I think that the one big thing that anybody out there who's a business owner should be really thinking about is their business structure. You have a lot of professionals that would be assumed that they are set up as a corporation of some sort. And I would say we probably have one or two calls at least a week that they're still in some level operating as a sole proprietor, or they even have maybe side investments or side things that they don't have under any kind of corporate umbrella. So choosing the right business entity is huge. The audience that listens to you primarily, though, that we're talking to are medical professionals, correct?
Correct.
So for medical professionals, on the bookkeeping side of things, they are, if we have the avatar of them, they probably have somebody in their office, or hopefully have somebody in their office that's handling their billing, that's taking care of, bookkeeping, that's doing the financial things. And there's still huge things that they can do. If you haven't listened to the news, I don't know, you'd have to be under a box to not realize that it's really challenging for any business to retain employees right now. And investing in your employees is a huge benefit that is kind of a double-sided. You invest in your employees, and I'll let Eric kind of jump in on different things that you can do to invest in your employees, but you invest in your employees and the employee stays with you.
Yeah. And I just want to make sure that did we address the question that you asked, Brett?
Yeah, the structure, and then kind of, it sounds like now into the bookkeeping piece that we're kind of moving on to.
So there is a lot of things that you can do within your corporate structure if you have one that you can't necessarily do as a sole proprietor. And the IRS makes that code distinction very important. Sole proprietors can write off a portion of their cell phone. They can write off a portion. They can do a home office expense and stuff like that. These are all awesome, and you should do them if you're a sole proprietor. But what if you were a corporation? Well, corporations can do it vastly different. And when a corporation reports its tax filing, it then generates a K-1 that then comes over to your personal taxes, right? And if it generates losses, then those losses come straight over. And then you can deduct that against your professional wages, right? Reducing your liability from your professional wages. So it's important for an individual to understand that the structure needs to be, the groundwork needs to be laid out correctly for you to build on it. And sometimes we don't necessarily know how to do that groundwork. And there's lots of ways to educate yourself. I don't necessarily recommend a DuckDuckGo or a Google education for yourself, but it is a great tool. The internet is an awesome tool to kind of spark a conversation with your professional on what may be available to you, right? Employee retention is one that Melissa just brought up, and that's really good. There was a bill that was signed by our current president a while ago during the COVID process that stated specifically that businesses, corporations, can reimburse employees for student loans. Why isn't this being talked about by everyone? Not student loans being paid off by the government, but corporations giving their employee money to pay their student loan that does not have any tax liability for the employee and is a 100% write-off for the business. And it's not an insignificant amount. Per employee, it's potentially upwards of $5,000. I mean, Brett, were you aware of that?
No.
But you don't know what you don't know. And these are some of the things that I specifically, I watch what goes on at the federal level in regards to the Senate. I watch what happens at state levels for a variety of legislation that's going through, because the tax code, it is very dry. It is something that will put you to sleep quickly, but it's constantly changing, either because the IRS is making modifications, what they refer to as white papers. There's been court cases that have established tort, or legislation has come through and is changed things either dramatically, like TCJA did in 2018, or more recent, like the COVID bills that went through that threw everything for a variety of loops, including like when people were supposed to file their taxes got moved. The football got moved in many ways for a lot of people. And now I'm really trying to work with, me and Melissa are really trying to work with people to educate them on some of the things that they may have missed out on. This student loan reimbursement from corporations is huge, because if you could, as a company, give your employee $5,000 with no payroll tax liability, with no employee tax income tax liability, and you just gave them $5,000 so that they can pay off their student loan, I, as an employee, would be like, you are the most awesome boss in the world ever. And so that's one of the things in regards to what may be missing on your books, right? I mean, how you track your expenditures and stuff like that, you could use an Excel spreadsheet. You can use graph paper and a pencil You can use QuickBooks Online, right? But it's the data that goes into it. What are you missing in that pool of data is what me and Melissa try to get our clients to zero in on.
Interesting. And when you mention corporate structure, you're referring to LLC to C Corp, like the full reign of structures, or is it specifically in the LLC range, LLC, S Corp, that kind of stuff?
So there's a lot of misunderstanding around what you just asked, and that's an excellent question, because a lot of people that we talk to will believe that they are set up, they're set, they're doing, what they have found in their, we'll say, Google education to maximize their taxes. And they'll have these calls, and it's almost like they're trying to get a gold star from us with us saying, yep, you've done all you can. But there's this misunderstanding about an LLC being a corporate structure. And while it is a level of protection and an umbrella, so to speak, when we talk about corporate structures as far as what's advantageous tax-wise for a business, what we're talking about is an S Corp or a C Corp. And there's, of course, definitely different pros and cons to each, which is what makes it all the more fun, right? To kind of figure that puzzle out.
So the S Corp and C Corp, these are more active type businesses, right? Where just a standard LLC that's where maybe I would hold real estate in just the standard LLC.
An LLC is a legal term that then gets used by companies for protections and baseline protections and stuff like that. As far as the IRS is concerned, they don't care if you're an LLC.
Pass through.
What they care about is if you're a partnership, an S corporation, a C corporation, or a nonprofit, right? So they care about how you are reporting the structure of the entity. And if you're an S corp, you have this section in the tax code that applies just to you. If you're a C corp, you have a section that applies just to you. Partnership, all the rest of them, right? And if you don't follow their rules to be in one of those categories, then you default to Schedule C, which is reported on your personal taxes, which is subject to 15.3% of self-employment tax on all leftover income. So your net from that business venture then is subject in its entirety to 15.3% worth of taxes. Whereas then if you were an S Corp, the profit in the S Corp isn't subject to the 15.3% of self-employment taxes, but you also have a different set of rules and I's that you have to dot and T's that you have to cross. So understanding how to be in one structure versus another is somewhat important. Now, do you have to dive into it and do a dissertation with a 10-page attachment on all of this? No. You literally just need to talk to someone that directs you puts you in the right direction of what structure, how you're reporting it, and last but not least, what are you doing within your bookkeeping and your expense data pool that is maximizing for your business alone. Do you have kids? That comes into play. I get that question all the time. My kids, do I get to write off my kids? Well, yes, you get to write off your kids. But does the business get to write off your kids? The answer is yes. How you do it, though, is very important. Mm-hmm. Because if you do it incorrectly, then down the road, the IRS says, no, this is a disallowed expense because, well, you didn't do it right. And you say, well, I'll change it. And they'll be like, no, too late. Take it out, right? You can't, you've lost access to it. Sometimes they go that route. Sometimes they say, okay, you modify it. You can still take some advantage. But a child in your business, one of your children in your business structure is potentially worth upwards of $14,000 a year in business deductions that essentially can cost you next to nothing. In truth, right? You want to pay your children for what they're doing for your business. Like our youngest son does a lot of administrative tasks for us. And the list is long and the list is varied. And he gets paid a wage for it, right? And because he's an employee of our company, he also has a Roth IRA, right? So now we're going down a whole new rabbit hole of how to take money from your company and move it in a non-taxable way to benefit your family as a whole, right? I mean, imagine if you had a 5-year-old child and they start helping you do things in your real estate business. And then you put a portion of money, say $5,000 a year, into a Roth IRA. Well, now they're 18 years old. They've had 13 years of a Roth IRA being built up on their behalf. They're going to school in style. They could actually have a down payment on a house that they can rent out to some fellow students. So now they've just become the property owner in their own right, because you've been setting aside a little bit of money every year for them for like the past 15 years, right?
Because
a lot of rabbit holes to go.
Because they are an employee, because they are producing for the business. The interesting piece of that too, Eric, is now that they are an employee, the business trips that you take that are your family are now going into this little beautiful thing of bookkeeping called the expense bucket, because it's all employees, right? It's very cool. It's what? Sorry, I missed that.
A corporate retreat.
Corporate retreat. Beautiful. And that you can even,
right?
Not that I would do this, but you one time a year, can you even buy alcohol for a corporate gathering or something like that? Now we're really going down a rabbit hole here.
See, there's a lot of things you don't know if you don't know. That one thing about that you can only buy alcohol for one corporate event, that's actually a corporate policy that was put forth by a major Fortune 500 company 25 years ago. It's not code.
Yeah, interesting.
Right?
Interesting.
So some things that we think are tax codes are actually established general business practices that may or may not be followed by the rest of the businesses around them.
So let me put this: if we're running an S corp and I am an employee of my S corp and I have student debt, I can pay my student debt through the S corp. That's very interesting. Very interesting piece there. The other thing, so the passive versus active in this, yeah.
The student loan by itself is not a write-off for you as an individual, because we're talking to other doctors and other medical professionals that are making money well outside that allows a student loan interest deduction, right? Student loan interest deductions for people that make $100,000, $200,000 a year, it doesn't exist. It's there, but you don't get to take advantage of it. With this, through your corporation, you're deducting upwards of $5,000 that you paid on the principal of your student loan, which is even greater than a student loan deduction by itself in most instances.
Mm-hmm. Interesting. So the last thing always pops into my mind is the active versus passive. When we have active income, a lot of physicians, doctors, people in the healthcare have these W-2 incomes. It's sometimes, I guess it may be a mental block that I have, difficult to offset that active income with these passive type losses that we're talking about. Short of the short-term world, what are some things that pop into your mind when I say that?
My love likes to talk about this, but I'm going to jump in on this.
Mm-hmm.
Even though you are a licensed medical professional, does not mean that the IRS could not potentially view you as a real estate professional.
Mm-hmm.
And it comes down to how many hours you dedicate to your business on an annual basis. The target number is 750. If you can show on a calendar, if asked, did you put 750 hours into your rental properties? And the answer is yes. Then the rental properties just moved from being passive to active.
Mm-hmm.
What about if they're not invested in real estate? What about if they're, because we have several clients, without getting too specific, that receive W-2 income from different facilities that they work for. How could they still differentiate between the active and passive income? How could they still benefit? I mean, there's I know the answer, but I'm trying to. I want to get you to say the big wow, or the exciting part, because the devil is truly in the details with this stuff.
So in this instance, you need to be able to prove that you are not only a healthcare professional, but you are a real estate professional. And a real estate professional, as far as the IRS is concerned, has nothing to do with credentials. It has nothing to do with passing a real estate exam or anything else like that in your state. The key is meeting that threshold of 750 hours of involvement.
But what if they're not involved in real estate?
Well, so the other passive income sources, they would have to come up with additional pathways.
Right. So I think he's missing your question. So let me say that there's the devil in the details is all about documenting expenses to make sure that they're capturing all of their actual expenses, their actual job-related expenses. And it still potentially could make sense for a medical professional. Let's say you have a doctor who's a concierge physician. And I'm only thinking about this because this was a call I had yesterday. So concierge physician, he receives W-2 wages from several different agencies. And he essentially said to me, there's probably nothing that you can do. Well, his income is enough to justify him becoming a corporation. And we talked about the difference between an S Corp and a C Corp. So by establishing him as a corporation, he's already giving himself that 15.3% cut by not having to pay self-employment tax. And that's kind of the piece when we whiteboard it, as we like to say, where we're writing it out and we're saying, okay, here's your specific situation, and here's what different parts of the tax code that apply to you. And it's different. I mean, people's tax situations are as different and unique as fingerprints. You can have two people that are medical professionals, and their tax scenario based upon, their household and a variety of different things can be completely different. So it sounds like low-hanging fruit. And there's probably people listening that are going, yeah, become a corporation. But 15.3% savings right off the top. That's huge.
Yeah, and it's setting yourself up. Then you have to be an employee in E130. So there's some other side effects of that, doing payroll.
Oh, yes.
And then knowing how much to pay yourself versus the disbursement, profit type disbursement. So if I'm paying myself, say out of $100,000, say I pay myself $50,000 a year, that other $50,000, how is that taxed?
That is taxed based upon how much is considered profit that comes across on your K-1, right? If your company if your corporation made 100,000 and you paid yourself 50,000, that means that you paid payroll taxes on that 50,000 and just that 50,000. But the company got to write off a portion of it, right? And you as an employee then also have a portion of it that gets reported on your personal taxes. That's all fine and dandy. But the remaining $50,000 of the corporation, what if after covering all of your expenses and paying off a portion of your student loan and paying your kids a wage and stuff like that, and then money's going all over the place out of the company's pocket, but it's not coming directly out of yours, and the company gets to write it off. That's a big difference. Corporations get to write off expenditures. Individuals generally do not, right? And even if you have like a lot of medical expenses or anything like that, you're like, well, can I itemize some of those things? Yeah, but there's some serious limitations and caps on those. Whereas in the business deductions, as long as it's a justified, reasonable, and expected business expense, then the business gets to write it off, right? If you as a person pay for your cell phone bill, the IRS doesn't give you credit for that. But if your business pays for that cell phone bill, it's a different story, right? And there's different strategies on how to pay for things. Paying for everything on the company credit card may not be in your best interest. And that's when a strategist comes into play and says, okay, change how you're doing this, and these benefits will start to pop up, right? If I could say to you, there are ways in the tax code to move a minimum of $12,000 out of your company into your pocket with no tax liability, and the company gets to write off that $12,000, would that be worth having a conversation with me?
And I think that's
the conversation costs.
Well, I think that's the wow factor. I think that's the question. There's so much about what we do right now and what we get to do right now, and I will assume it'll be what we do for the rest of our careers. That's about educating, and that's about letting people know that question that Eric just said of the question that we pose of if there are some small changes, because it's not about changing what people are doing or telling our clients that they need to make these huge changes. There is a little bit of accountability that we require from our clients. That would probably be the biggest change is we can give advice until we're blue in the face, but if you're not going to take the advice, then there's nothing that we can do, right? It's not a magic wand. But aside from the small amount of accountability, the change that people will see, I mean, he says it's less than this, but what I've seen when I've actually done the numbers is it's close to a 40% reduction in our clients' tax liability. Wow. So 40%. Now, I'm not promising that. I'm not saying that, like, you call us and we'll, I don't know what some loud, obnoxious billboard would be, but 40% is certainly worth a conversation. As far as your question about how much does that conversation cost, one of the things that we, and I know that all tax professionals, of course, price their services differently, but what we aim for is how much of a return on the investment, Eric? Is it a 3-time return?
I base all of it on a minimum of a 3-to-1 return.
Right.
You give me $1, I'll show you routes within your corporate structure to save $3. And if that exchange seems fair to you, then let's have a conversation. And if I can get the return to be upwards of 5 or 6-to-1, I'm not going to charge you any more for that. That's just a side benefit for you. And when I'm saying saving you money, I'm talking just at the federal level alone. States come into play at random levels, but if I'm saving you money at the federal level, it defaults that you're saving money at the state level as well. So like my client who I spoke to earlier this week paid $120,000 to the Fed and then another $40,000 to the state of California. And I ran the numbers with him and I showed him how to recapture against that. But then also that point going forward, I immediately showed him how to get back about $38,000. And he said, we're in business. And I said, that's awesome. I'll send you a contract. It really was that simple. I said, okay, here's a couple of things that we can do immediately to recover into last year and also this year going forward. And he's like, why didn't I know about this? Why didn't my tax guy tell me? And I said, your tax guy, you have a conversation with your tax guy once a year after the year is done. There's not much they can do at that point. You need to talk to a strategist or a professional in the year you want to do something. I want to save money on taxes for 2024. I'm going to have a conversation with someone about that in 2024. Because having a conversation in 2025 on how to save money in 2024 doesn't work.
Yep. And even in quarters, like through the third quarter, you should be pretty close to projecting what you're doing in quarter four. So that time is rolling right around. The time has come to start having these conversations, being proactive instead of reactive. And it's the real deal. And don't push it to the last minute either. You find yourself in these scenarios of being with tax rich and cash poor. You know what I mean? There's this way of trying to jump the gun and hit these things and then things don't work out. But having the right team on your side is really important and making those connections. How can the listeners connect with you guys?
Best way to connect with us is to visit our website, busybeeadvisors.com. I'm sure it'll be in the show notes. You can schedule appointments with us from there. We've got tons of information on the website. We're updating it. Gosh, we're putting new information up probably daily on our website with just different podcasts that we've been featured on and blog posts and things along those lines. So there's always new information up on the website.
Busybeeadvisors.com, BUSYBEEADVISORS.com. There's a phone number on there too for the listeners that go straight to the phone. 916-400-3500 as well too. Melissa, you mentioned that we have something to congratulate you on, right? Something just happened.
So my second book has just been published and released on Amazon. Eric, can you show the picture, because mine keeps blurring out when I try.
Look at the slow rise.
But I'd love to offer all of your listeners a free copy, free hard copy of the book to be mailed to them. If
the
they
4-hour bookkeeper.
Yep. They want to visit the website. Sorry, him doing that is so distracting to me. Visit our website, Busy Bee Advisors. Fill out the comment section, and we'll send you a copy of the
That's
book.
Awesome. The 4-hour bookkeeper. Awesome way to wrap this conversation up. And I know I could go on for hours and hours picking and learning. What I like about this conversation is so many of these things that we've talked about, I've implemented in my family through the years. So definitely hitting those notes. So just to kind of back the idea piece with real world action, that's some things that we've done as well. So that is really cool. If you could go back, say 15 years with what you know now in the bookkeeping, taxes, life, entrepreneurial perspective, and you sat beside a 15-year younger Melissa and Eric, what would you tell them?
I would have started the firm 15 years ago. I would have encouraged a younger me to jump in and start this. It's been such a blessing for our family, not to get all crazy and emotional, but to be able to not miss anything with our kids, and what we've done for clients as well, in the relationships. We just took a trip. You talked about trips. We just took a trip, and we really view a lot of our clients as good friends. And one of our stops on the trip was to have dinner with a client in his home in Tennessee, and we were greeted with open arms. I don't know a lot of people that really open their doors to their tax professionals and are like, come over for dinner. Let's have gosh, it turned into like a 6-hour dinner. It was
nice.
Awesome. So
start sooner.
Yeah, start sooner. Jump in, take the leap.
Well, that is great news. And on that note, we will end up. Everybody who is interested in a conversation, this has been a great conversation. I appreciate your time, Melissa. I appreciate your time, Eric, and the experience that you've shared with us today as well, too. And you continue to share this so everybody can go to busybeeadvisors.com to see what you're up to, listen to other podcasts, get some more of those nuggets that you talked about that you're dropping, and connect with you. Get that free book and take the next step to making that change in your life. To get from that 99% to that 1% is just that self-realization that is, hey, I need to reach out. I need to go to somebody who knows more about this than I do. I need to surround myself with people who have experience in this and who are crazy enough to be passionate about it, right? And that is you. Thank you guys so much. To the listeners out there today, thank you for your time. And as always, your attention that you place on the things that mean the most to you in your life, like your family and your finances. It's really important. Nobody's going to care more about your money than you do. Just because you pay them to do something with your money doesn't mean that they care about your money. You got to be around the right people. So give those types of things your attention. Thank you for listening. This is the Real Estate Mogul MD.